There are few high probability setups. There are few high probability setups, but one of the most important high probability setups that we can identify using price action is a with trend setup. Why? Because on most charts, there are multiple trends being present, whether it is a big trend, the large trend for the day, or just a bunch of small trends that are working inside of a trend range. Unless the trend range is very tight, there are small trends playing out. Every trend has multiple phases. We have a correction phase and we have a push phase. Correction phase followed by a push phase, correction phase followed by a push phase, correction phase, and followed by another push phase. This is the behavior according to price action when it comes to trends. And the burden on traders is to identify where this correction is over and when the push phase is about to begin. Because if you can understand and read the market correctly, when the push phase is about to begin, you can capitalize on the with trend momentum. And this is where our high probability price action setup will come into play. As price action traders, we can identify when the correction is over just by counting bars, just by looking at the proper pattern. Now, two-legged pullback is a number one high probability setup if it forms under the right conditions. We're going to talk about what those right conditions are. Two-legged pullback helps us to identify when the correction is over and when the push phase can potentially begin. And it comes down to human psychology, to human behavior. When humans try something once, they will just not give up. They will try it one more time to see if it will fail again or if it works. Two-legged pullback will offer a second entry high probability setup. Now, second entry, if it forms under the right conditions, it needs to form at proper key entry points. The key entry points are trend lines, exponential moving average 21 bar EMA, and support and resistance key levels. As a price action trader, you're not interested in using any indicators. You need to learn to read the price action alone, just using the price action tools. And the correction needs to play out for second entry to be a high probability. The two-legged pullback will hint us where it is the safe place to sell since we're talking about downtrend. In order for us to safely identify the two-legged pullback and second entry short, we need to understand how to count the legs. The bullish leg is a series of bullish bars, or it can be even just one bullish bar. Bearish leg is a series of bearish bars. It can be just one bearish bar. And since we have a downtrend working lower, when we are looking for opportunity to sell, when we're looking for the two-legged pullback, we always start the count from the lowest low. So this right here is the lowest low. It broke lower, count reset. So this is the lowest low inside of this downtrend. So this is where the count begins. And we can see that we have first bullish leg. The first bullish leg consists of this one bullish bar, the second bullish bar. Now this bullish leg is going to be in play unless there's a break below the low of the last bar inside a series of the bullish leg. We have a series of two bars, first bullish leg, second bullish leg, and suddenly we have a break below the low of this bar right here, indicating first entry short, and the first bullish leg played out, and the first bullish leg is over, and the first bearish leg may begin. Notice the second leg is continuing, and this right here is the second bullish leg, and we have a break below indicating a second entry short. This right here is the first bar, second bar, and third bar. On the third bar of this second bullish leg, we finally had a break below its low, indicating that the second bullish leg played out. And this is the two-legged pullback, indicating to us that the bullish correction played out and the main trend resumed. That's the whole point of this two-legged pullback, of this price action setup. It will tell you when you can start looking for resuming the trend and looking to sell if it forms at the right key entry point, which it did, and the other conditions are in favor as well. Every time the leg will be broken, it will form a chance for sellers to sell. So this right here is the first bullish leg, trigger below indicating first entry short, second bullish leg forming, trigger below indicating second entry short. It resulted in a nice trend continuation setup. Downtrend is in play, and we have another key entry point trend line, so you combine two key entry points and a two-legged pullback. This is a high probability setup just by counting bars. Bearish leg can be series of multiple bearish bars or just one bearish bar. Our first bearish leg inside of this correction is a two-bar leg. We have a first bearish bar followed by a second bearish bar. There is no trigger above neither one of these bars highs. And then we have a third bar creating this first bearish leg, but we have a trigger above. Notice one tick trigger above this bar right here, indicating first entry long, and the first bearish leg is broken. And then we have a second bearish leg starting to form because the first entry long was stopped. So we have a second bearish leg. The next bar after this big bearish bar just had a trigger above its high, indicating that this second bearish leg is over. And we have a first entry long, pullback, second entry long, first leg down, pullback, second leg down. This is a two-legged pullback at the key entry point, indicating that the bearish pullback played out, that it is okay to resume the buys and be buying the market at this point. And also notice you have a small little high here, but this high is higher by just one tick, which means you reset the count from the highest high. The highest high is always the place when the count is being reset. We start our count from this high right here. First entry long, second entry long. First entry long and the first entries in general may not be as reliable because they're indicating that the correction may continue. The pullback may not be over just yet. Only after there are two legs and there's the second attempt, this is where the bears will throw in the towel and bulls are about to resume the market. As a price action trader, I'm going to use the exponential moving average just as a supportive indicator to help me identify where possible key entry points are going to be, and I'm going to be drawing short-term or long-term trend lines so I can properly identify the key entry point. And at that point, once I see that the structure is bullish, I'm just looking for pullbacks and looking for triggers if there's a second entry. There's a first bearish leg, first bar, second bar, third bar, no break above, and then we have a bullish bar indicating break above. So this first bearish leg is over and first bullish leg may start. Second bearish leg started, and then we have trigger above this bullish bar indicating a second entry long new high, first entry long pullback, second entry long trend, resumption entry. As the trend is continuing, I'm just looking for the same pattern all over again. New high right here, which I'm going to reset the count. I'm going to count here, but we have only first entry long and count reset. New high, first bearish leg, one single bearish bar, instantly formed a first entry long just by one tick, broke above the high of this bullish bar. The second bearish leg is continuing, making its way all the way to key entry point, and above this doji bar, a second entry long triggered. First leg, first entry long, second bearish leg, second entry long. We have a first entry long, pullback, second entry long. You can see sometimes the legs may not be as visible. This right here is a first bearish leg.
Forex.com, the #1 Forex broker in the US. Part of
First entry long just by one tick, break below, and we have a second entry long. It can be this tiny, but it is a variation of a two-legged pullback, and it is a second entry long at two key entry points while the uptrend is about to resume. And this pattern appears on every single time frame and on every single instrument. This is Apple stock weekly time frame. Here we have a NASDAQ 5-minute chart. We have a new low form right here. First entry short, break below, pullback, second entry short at two key entry points. Notice this bullish leg has one bearish bar inside of it. Does that concern us? No, that doesn't, because there is no break below this bearish bar. That doesn't mean what color it is. As long as there is no break, the bullish leg continues. The bullish leg was broken right here after there's a one tick break below this bar right here. Second bullish leg continuing, second entry short, where I can continue pushing lower. New low, first entry short, pullback, second entry short. So in this scenario, bullish leg is just one bar here, correction, second bar here, bullish leg ended, new low formed, first entry short, pullback, second entry short. Two-legged pullback at the key entry point. Two-legged pullback is designed to predict a small market move for a scalp. You're not about to predict a massive swing trade. You're about to predict a smaller portion of a scalp from two key entry points to resume the trend after the correction played out. Daily chart, the Bitcoin, new high formed, first bearish leg, first entry long, trigger above this bar right here, second bearish leg continuing, two bearish bars, and the second entry long. Second entry long triggered technically above this bar right here, but you need to go long above bullish bar. So this is why I'm marking this bar right here. Another new high, first entry long just by one single tick. This bar right here broke one tick higher above this bullish bar, instantly stopping the first entry long because the correction may continue. Sometimes first entries will work, sometimes they won't. It is all 50-50 and you will not make consistent money. You will only make it consistent if you keep waiting for the high probability setup to make its way to the key entry point, and there is a second entry long forming. First bearish leg, pullback, second bearish leg, and a second entry long. Your stop loss goes one tick above the signal bar. You would have had to ride this out, but eventually market would resume and the uptrend would continue. And here we have a micro two-legged pullback because we have a new high right here. First bearish bar, second bearish bar, third bearish bar, all indicating bearish momentum. we have a trigger one tick above this bearish bar indicating first entry long, and then it got stopped instantly. And notice while the first entry long was stopped, the bar instantly reversed to the upside, forming a second entry long on the same bar when the first entry long was stopped. New high, first entry long, it stopped, second entry long, one tick above this bar right here. Goal of a price action trader is to predict where the pullback is going to end, and when the trend is going to resume, the correction phase will end and push phase will begin, and the two-leg gap pullback is indication of bearish momentum being over depleting, and buyers are about to step in, allowing you to buy low and sell high. New high formed, first bearish leg, no tick above this bar right here remains unbroken, and right here we have even continuation of the first bearish leg. This inside bar has one tick trigger above its high, breaking the first bearish leg, indicating first entry long, pullback, second bearish leg beginning, second entry long. Right here, stop loss goes one tick below the entire swing. In this case, because this is an inside bar, it is at key entry point, new high, bearish leg continuing, no break above its highs. First bar that received a break above its high, first entry long, pullback, second entry long at two key entry points, another new high indicating push phase is about to end, correction phase is beginning, first entry long, take one tick higher, pullback, two bar bearish leg, second entry long, triggering one tick trigger above its high right here on this inside bar of two key entry points. We can see two bearish legs in each correction. Now, second entry needs to form under the right conditions for us to consider it a high probability setup. It needs to form at the key entry point. The correction trend has to play out. Signal bar must be bullish to go long, and signal bar must be bearish to go short. And what does it mean? Correction has to play out. You're drawing the channels for the main trends, but you're also drawing the channels for the shortened corrections. If you have a bearish downtrend, the bullish correction has a trend inside of it as well, and it needs to form a new extreme for us to consider the opportunity safe to sell. New low, correction in play, no safe entry to sell. New low, correction in play, break, new high of the correction indicating that this bullish trend played out, and we have a first entry short coming from this low, first attempt to sell, pullback, second attempt to sell. By the bears is a two key entry point, signal bar is bearish, and correction played out. This is a high probability price action setup, followed by a lower high confirmation setup and a failed second entry long. Second entry long is going to be a trap. Why? Because the context is bearish. So you can use even the two-leg pullback in opposite direction to help you identify a trap, but it's a whole nother story.
I chose Wix